Hi everyone, my name is cpourse and I'm the CEO and founder of Futures Road. Thank you very much for taking the time today to join us for this webinar. At Futures Road, we qualify day traders. Our activity is based on the value profile methodology, which is a unique methodology, and we will refer it in details later on in this webinar. Please notice that you can communicate with us using either the email address or the website that appear in front of you. info@futuresroad.com, www.futuresroad.com. Just before moving on, let's go through the disclaimer. The presentation is for informational and educational purposes only and should not be perceived as an investment advice. Trading equities and futures involve the risk of losing capital and is not appropriate for everyone. Past performance does not guarantee and is not an indication of future performance. Trader is encouraged to use risk capital for trading whose complete loss will not affect trader's lifestyle. Referring instruments in this presentation should not be perceived as an implicit or explicit recommendation to trade those instruments. Any trading decision will be taken by a presentation participant is only by participant responsibility. The presenter does not assume any responsibility for participants' actions. My name is cpourse. A few words about myself. I was working in the high-tech industry for about 25 years and executed various of interesting positions in the arenas of communication, telecom, remote control systems, as a software developer, software designer, technological leader, and a manager of teams and projects. By the end of 2005, I started studying technical analysis, and then at the beginning of 2006 started trading after a few months of practice. I have traded stock, ETF, options, forex and futures, and since 2009 trading futures only. I am the founder and the CEO of Futures Road and the educator at our courses, and of course an active day trader. Let's try to focus and define the main issue of this webinar: why so many traders fail. In order to answer this question, we need to identify the capabilities that are required in order to trade successfully. The capabilities list is in front of you: market analysis methodology, trading execution capability, mental control, risk and money management. These capabilities are built one on top of the lower one. Each capability is valid only if the one preceding it is fully implemented by the trader. Otherwise, it is invalid, in which case the trader is not equipped for trading. Market analysis methodology means the capability to identify the price structure of the market for a given instrument. There are prices that are more attractive than the other ones. The price development target is not accidental or random. Price moves between attractive prices. Trading execution means taking a trade on time, based on the understanding in real time who is controlling the market, whether the buyers or the sellers. Being able to identify the most attractive prices and the time and direction of price development means that one can trade profitably and with confidence. We claim that most traders do not control the first two capabilities in the list, which sadly means they do not have the chance to trade profitably in the long term. Later on, during the next slides, I will explain why this claim is valid. After claiming that most traders do not have the chance to trade profitably in the long term, I would like us to consider a few facts. Fact number 1. Technical methodologies make assumptions which are claimed to be based on some statistics. Did you ever meet a book or a work that presented these statistics? Or that either reaffirmed or updated statistics? I never met such statistics, neither many people I asked the same questions. Fact number 2. How come supporting industry flowers like proprietary indicators, market secrets and strategies. Amazing, huh? Empty high words. Signaling services, trading rooms, specific instrument academy. Wow! If tech methodologies are that good, then why the supporting industry 1 is required? 2. Flowers. How come? Do you have any answer for these questions? Fact number 3. Technical methodologies do not understand marketplace behavior. This means that when the market's behavior is changing, technical methodologies fail to anticipate price development. Markets went through a very significant change during the last 30-35 years. All is under change around us. Communication infrastructure, computers, trading software. Let's check it out, whether the markets really changed during the last 30-35 years. Let's take a look at the figure in front of us. The figure unfolds the change that the market went through during the last 35 years. In the center of the figure, we can see the time X. Please take a look. Here is the time X. Above the time X, the figure refers to the development of volatility in the markets, and as we can see, along the time, the volatility went higher and higher. Below the time X, the figure refers the tech methodology tool's effectiveness, and as we can see, it went higher, and then since then, it is going lower and lower and lower. The figure refers to extremely important events that affected the trading market. The first event took place during the mid-80s, the deployment of the Internet. The second event took place during the early 90s, where HFTMs started trading. HFTM stands for High Frequency Trading Machines. We are about to describe in the next slides how the markets were affected by these important events. So what happened until the mid-80s when the Internet deployment has started? The communication technology that days was based on the phone system, on the phone network. The trader couldn't see the price being changed in front of him on the screen as we see it today. He could only hear it through the phone and write it down in front of him. Then after a while required to take trading decisions, the trader required to call back his broker through a phone call in order to tell him about his trading decisions. What I'm describing here is actually a long cycle of taking trading decisions. What is the meaning? The meaning is entering and exiting position were infrequent, and this necessarily yields a low volatility market, because high volatility can only develop in a market where entering and exiting positions are taken frequently. What is happening during and after the mid-80s? Well, first of all, Internet deployment has been launched, and this means that Internet is making market information available at residence and office. No need to call a broker or a bank. Second, market information is reaching traders at real time, almost immediately. All of this means that a shorter cycle of taking trading decisions is created. If we compare it to the previous situation when trading was heavily relying on the phone network, where this cycle required at the least a few hours, then in this case the cycle has got much shorter, and now it requires few seconds or a few minutes at the most. And what is the meaning? Very simple. Increased frequency of entering and exiting positions, which necessarily yields an increasing volatility market. During the early 90s, a new phenomena came in. These are the HFTMs. HFTMs are high-frequency trading machines. These are ultra-fast computers running algo trading. These machines are using ultra-fast dedicated communication links, not the regular internet connection. Forget about phone calls. They are working in an ultra-high speed. They are trading tens and thousands of instruments simultaneously. The result is an ultra-short cycle of taking trading decisions. In this case, this cycle is going down to a few microseconds. What is the meaning? Very simple. Very high frequency of entering and exiting positions, which necessarily means a very high volatility market. So let's ask again, had the markets really changed? Well, the answer is very clear. Definitely, the markets went through a dramatic change, not less than dramatic. In the previous slides, we observed the changes that the markets went through. And this slide, I would like to consider the issue of trading methodologies and whether they are adequate for nowadays markets. Well, technical methodologies have been developed since the early stages of the 20th century, started with Dow theory and include many methodologies and studies released thereafter. The glory years of the tech methodologies were during the 70s to the late 80s of the 20th century. They were developed for a totally different market. As markets volatility became significantly higher, old tech methodologies proved to be lagging and imprecise, hence ineffective for day trading. It was obvious that a change is required in order to trade nowadays markets. Our analysis and trading methodology is called value profile. In order to understand value profile, we need to understand what is value. If you watch a chart, there is a price X, but there is no designation of value, right? So we need to understand the term value before we move forward. In order to understand what is the value, let's just take an example. Tomatoes. During the summer, tomatoes are priced X. During the winter, tomatoes are priced Y. And usually, as you know, Y is greater than X. Same product, different prices. Why? Correct, different value. The weather condition affected supply, so the value has changed. After we went through an example that explains the idea behind the term value, then we can move to the arena of trading. And with futures and equities, the value is being changed when financial and economic news are being released. Okay, so this is changing the value of an instrument, or if you like, the value of the base product. Thereafter comes a change in price to reflect the change in value. So the definition of value is a range of prices. Each value zone requires the definition of price levels of the value zone boundaries. This is in order to define the price range of this value zone. Some value zones require the definition of a price level of the equilibrium. This is what I referred at the beginning of this webinar by the term attractive prices. Okay, it will be much more clear on the next slide as we will see a figure, and I will refer it then. The task of drawing and defining the price levels mentioned above is performed daily during the PMA stage as part of getting prepared for the trading day. Just to keep things simple, PMA stands for pre-market analysis. This slide is in order to conclude everything that we have mentioned on previous slides in order to explain the term value. This is a very typical chart. We can see here how the price is moving upwards and downwards and sideways, of course. But I would like to focus on this chart. I would like to focus on the value zones. We can see here 4 value zones, and we can see that the value zone has boundaries that define the price range of this value zone. This is exactly what I defined before on a previous slide. In addition to that, I would like to point the equilibrium level, or what I referred at the beginning of this webinar as attractive prices. We can see that the price is moving when it leaves a value zone. When it exits a value zone, it is moving to a value zone of the next equilibrium or attractive price level. The task of drawing the equilibrium level and the boundaries levels is a very simple task. It is just a part of the PMA, the pre-market analysis, which requires daily between 5 to 10 minutes when we prepare ourselves for the trading day. I need to say that once we have this price levels drawn on the chart, we have very important information because we understand the price structure of the instrument that we intend to trade. I would like to conclude and go through the main properties of the value profile methodology. It is simple to study and implement. It is highly efficient. It means trading with confidence. It means trading with clean charts, no indicators, no oscillators. You will never need it. Value profile is a decade for trading any instrument at any market. It is a decade for trading all instrument types, equities, futures, options. Forex is an exception. Why? Because no volume feed is provided for Forex. Value profile is a decade for all time frames. Value profile requires real-time volume feed. This requirement is implemented by every feed that your platform, your trading platform, is receiving in order to display the trading information. There is no need for any additional software or any additional feed. The chart in front of you is presenting real trading data received from the exchange through the data feed. The chart is presenting two important aspects of value profile methodology. The upper portion depicts the price structure of the instrument being traded. You can see here the boundary levels and you can see here the equilibrium levels as explained on previous slides of this webinar. The lower portion depicts how the market dominating force is being identified at real time. We will not go into it, but this is how it looks, and it assists the trader in identifying a very important information. Who is the dominating power in the market, whether the buyers or the sellers? For both purposes, only volume is being used. I want to remind you that the price is only the result. The cause is the volume. This is why we analyze volume only. I would like to describe our day trader qualification process. The process is composed of two stages. The first stage is the theoretical course. This course is of 8 weekly meetings. Each is 4 academic hours long. The course assumes that the student knows nothing about trading. We cover every topic bottom up, from getting to know the very basic trading environment terms to the up to the value profile methodology details. The theoretical course meetings are web-based, which means a virtual meeting very much like a webinar, except that all participants can talk, listen at real time, very much like any other real meeting. The course language is English. The second stage is practicing with mentoring. The importance of this stage is that the student is not left alone to cope with professional and administrative issues being encountered during the practice stage. Practice with mentoring stage is 4 months long, and the student is entitled to have 90 minutes monthly to communicate with his mentor. The communication with the mentor is fluent and is issues driven. The communication is internet based. It is managed by emails or Skype, and we are using the English language for that matter. This stage is optional. To conclude this webinar, I would say the following. Technical methodologies became irrelevant due to the significant changes in the market. By using technical methodologies, a trader defines his failure. We recommend trading based on market understanding rather than by following signals. We offer very advanced modern methodology to analyze the market and manage your trades, the value profile methodology. We offer a very thorough qualification process. We invite you to move forward to your success. Call us today.